Okay, so now we're talking about 1231. And this is one of those separately stated items that we had on the K1, was it or was it not? It was. Why do we have a whole binder on 1231? Well, there's a couple reasons. One is there are, from one sale transaction, the result of the gain can show up in not one spot on the return, not two spots on the return, not three spots on the return, but up to 4 spots. Fair? So this is about showing you the variations of the number of places one gain calculation can show up on a tax return. The second thing is understanding what 1231 is and what it means and how it works. And so let's see, before I get ahead of myself. Okay, so let's see. Allie, what's this say?
General rule, gain exceeds loss if A, the section 1231 gain for any taxable year exceeds B, the section 1231 loss for such taxable year. Such gain and losses shall be treated as long-term capital gains or long-term capital losses as the case may be.
Okay, so does that sound a little bit like the netting that we were talking about earlier? Maybe. So Allie, who you want to call on? Chris? What's gains do not exceed losses?
If A, the section 1231 gains for any taxable year do not exceed B, the section 1231 losses for such taxable year, such gains and losses shall not be treated as gains and losses from sales or exchanges of capital assets.
Okay, did you just highlight that whole thing, Jackson?
Yeah, basically.
Okay, give me your green highlighter. Highlight, everybody highlight on such gains and losses shall not be treated as gain or losses from the sale or exchange. Exactly what you just highlighted, so you're good.
Okay.
Okay? Okay, so sale or exchange, actually this is pretty damn important. Okay? Sale or exchange is a doorway. Okay, it is something that helps Sam
Diagnose.
Okay, so what that says, it says what again, Jackson?
Such gains and losses shall not be treated as gains and losses from sales or exchanges of capital assets.
Huh. All right. So that's going to rear its head in one of the examples that we have. So sale or exchange is a term of art. In order to have a 1231 gain, you have to have a sale or exchange of an item. In order to have a capital gain, you have to have a sale or exchange of an item. So what happens if you don't have a sale or exchange? And you have this table and you just throw it in the dumpster. Do you have a sale or exchange? You don't. You have an abandonment. And we're going to talk a little bit about abandonment today, but if you have abandonment in a business context, you throw this in the dumpster and there's $100 of net book value left in this asset. We throw it in the dumpster, it's an ordinary write-off. Abandonment, so here's the general rule for abandonment. Abandonment, when you throw something in the dumpster and just abandon it, or you leave it on the side of the highway, it's an ordinary loss. So Max, a good practitioner, knows the rules.
Correct.
A better one knows the exception.
And then an even better knows the exception to the
Knows the exception to the exception. Okay, so I just gave you a rule. And what was that rule that I just gave you just now, Max?
Abandonment is ordinary loss.
Because there's no sale or exchange.
Correct.
Okay, that's the important part. Abandonment is ordinary loss because there is no sale or exchange. Sale or exchange opens the door or the window to get to capital gain treatment or to 1231 treatment. If we throw the table into the dumpster, then it's abandonment. So now I'm going to give you an exception, and I'm going to give you the flip side of why the words sale or exchange are important. Who did we talk about earlier about 409A? What was that company?
Enron.
Enron. So do you think there were a lot of people in the world that had Enron stock that might have wrote it down to zero? And they got nothing out of it? Did they have the ability to sell or exchange their Enron stock? Okay, so the rule I just gave you was what? They can abandon it, they can throw it in the trash can, they can throw it away. And if they have basis in their Enron stock, what rule did I just give you, Max?
It's an ordinary loss.
And why is it an ordinary loss?
So there's no sale or exchange.
There's no sale or exchange. A good practitioner, Max,
Knows the rule.
a better practitioner,
Knows the exception to the rule.
knows the exception to the rule. So here's the exception to the rule. Okay, abandonment results in ordinary loss because there's no sale or exchange.
Correct.
Did I sell or exchange my Enron stock?
No.
I did not. So should I get ordinary treatment? There's only one answer, and it's going to be no.
Right.
Okay? So 165G says that if you abandon your stock, that you got nothing out of it, we're going to treat it as if you had a sale or exchange of your asset. So even though you abandoned your stock and you threw it in the dumpster, the code says, we're going to treat you as having sold or exchanged that stock. And if you have sale or exchange, do you get abandonment treatment, Max?
No.
You get what kind of treatment?
You get ordinary treatment.
No,
Oh, for
sale or exchange. Well, it'd be like capital. So is it better to have an ordinary loss associated with your Enron stock or capital?
ordinary.
Ordinary, because is there a limitation?
No.
If you have a capital loss, what's the annual limitation if you don't have any other capital gains? $3,000. So abandonment, starting point is if you abandon something, it's ordinary. It's an ordinary loss. If you abandon stock, the code says, no, we're going to treat you as if you sold and exchanged it, so you can't abandon it. There is an exception to the rule. Okay? So let's go back to gains or losses do not exceed. Who read that?
Me.
Who? Oh, go ahead. What's it say?
Such gains and losses.
Gains do not exceed.
A, Section 1231 gains for any taxable year do not exceed the Section 1231 losses. Such gains and losses shall not be treated as gains and losses from sales or exchanges. So would they be treated as ordinary?
That's exactly what that's telling you.
Yep.
The fact that it's saying it's not treated as sale or exchange says you abandon it for purposes of this section and it's treated as ordinary. Okay? So Allie, what did A say? Where gains do exceed losses?
Treat it as capital.
Treated as capital. Okay? So when we go to okay, I'm going to come back to that. So when we come back to the sheet, which is 1231 netting, I don't know if you guys put a post-it on that in the other book, but I think this is worthy of putting a post-it on this one. This is what we just read. It says, step 1, net all current year gains and losses. If it nets to a loss, it's B that says it's ordinary, because isn't that what you said, Chris? Yeah. It nets to, it's treated as abandonment or ordinary loss. Okay? Or if gain equals, if it's net gain, go to step 2. And there was nothing in there, and I don't know really where to find this in the code section off the top of my head, but let's talk about this just for a second, and we'll show it. Okay? So we know that based on what Allie said, if gain exceeds losses, Allie, what's it mean?
Capital gain.
Capital. Well, that's not 100% true because of what we're getting ready to talk about. And I'm sure that this is somewhere in here, but I don't know where, so I'm just going to do it now. So we're going to do this 2 ways. Year 1, year 2. Okay? Oops. And I'm going to say that I have asset 1, asset 2. And I'm going to say net book value, probably a good way of doing it, is $1,000 on both. Okay? If I sell asset 1 in year 1 for $500 proceeds, what's my basis? CV?
So I wasn't paying attention.
That's all right. So let's do it again. Okay? I got year 1, year 2. I have asset 1 and asset 2. I have tax net book value of $1,000 in both those. I'm selling asset 1 in I'm going to change this to 2,000. Okay? If I sell it for $2,000, what's my basis?
1,000.
1,000. What's my gain?
1,000.
So per Ali's rule, should my gain exceeds, I have a gain, correct? And that's the only activity I have. So in year 2, I sell asset 2 for $500. What's my basis?
1,000.
1,000. What's my gain or loss?
Loss of 500.
500. According to Chris's rule, what's the character of that?
Ordinary.
How do you feel about that, Chris? Is it ordinary? It is. Okay? So now let's reflect back on what this says here. This says, in step 1, net all your gains and losses. If you have a net loss, then it's ordinary. Correct? Net them. If you have net gain, you go to step 2. We'll not worry about that just yet. Under the rules that we have set so far, we got a capital gain and an ordinary loss. And that is consistent with how the code section reads. But now we have to reflect on, well, wait a minute, if I have a net gain, go to step 2. I'm going to invert this for a second, and I'm going to change this to asset 2 and asset 1, and change this to 2,000 and this to 500. We have a loss in year 1, ordinary, correct? Now in year 2, we have a gain of 1,000. So it says go to step 2. So what's step 2 telling us that we need to do? Once current year net gain is determined, do I have any prior unrecaptured 1231 losses? And you have to look back for a period of 5 years. So in this case, I have year 1 and year 2. In year 1, I have a loss of $500. Okay? So what this says, to the extent in the past 5 years, and I'm not going to do it. I look back 5 years, which would make me negative 1, 2, and 3, if I had looked back 5 years using 1 as a proxy for a correct mark. And I'm going to say that every other year is 0 in terms of 1231 losses. So my population of 1231 losses in the past 5 years is 500. To the extent I have a current year 1231 gain, I have to characterize that gain as ordinary to the extent of the prior year loss. So this 1,000 is 500 ordinary and 500 capital. Okay, so step 1 is, I'm going to call it the Ali and Chris rule. To the extent you have 1231 gains exceeding losses, it's capital, except for the netting part that we just talked about. Or the Chris rule that says if losses exceed gains, it's ordinary. Right? But then we have to be smart enough to look back for a period of 5 years prior to this year to say, if I have a 1231 net gain in the current year, have I taken any 1231 losses in prior years that resulted in an ordinary write-off? And if the answer to that is yes, then you got to recharacterize the current year 1231 gain as ordinary to the extent you've taken losses in the past. Okay, and if, in this case, in year 2, to the extent of the prior year loss 1231, it's ordinary, so 500. To the extent 1231 is more, it goes to 3, which is Schedule D. So 500 goes to Schedule D as capital, 500 is ordinary because in year 1 I had a $500 loss. Does anybody have any questions about that? Okay. Chris, who do you want to call in?
Let's go, Matt.
Matt, what's this say?
Says, start at the top there.
No, general, where it's highlighted.
Okay. General rule, the term property used in trade or business means property used in the trade or business of a character which is subject to the allowance for depreciation provided in section 167, held for more than 1 year, and real property used in the trade or business held for more than 1 year, which is not A, property.
Yeah, don't worry about that.
Okay.
Okay. So when I said earlier, definition of 1231, because now 1231 is a category. It's a couple things, but first and foremost, it's category. Okay, and the category says if you fit into this category, you have to follow the Sailor Exchange rule treatment, and you have to follow this 1231 netting. It's a way of, Sam, diagnosing what you're dealing with. Okay, so in order to make a determination of whether you have 1231 property, you have to say, wait a minute, it's going to come in one of two categories. Okay, is 1231 is two things. Is that what it said, Matt?
Correct.
And what were those two things?
Property used in trade or business.
Does it say property or tangible property? All right, go ahead. Property, use, trade, or business.
Okay. Of a character which is subject to the allowance for depreciation.
Okay, so we're going to say depreciable property, correct?
Yes. And held for more than 1 year.
And held for more than 1 year. Okay. And what else?
Which is not those three things up there.
Nope, and then there's and right here.
Real property used in trade or business.
And real property used in trade or business. So you have real property and you have depreciable property. Okay? So you think real property is land? Okay. And do you think depreciable property is subdivided in between maybe tangible personal property and buildings? So tangible personal property and building. Okay, so knowing 1231 is real property used in a trade or business. So let me ask this question, Matt. I'm a farmer, I farm. Is my land 1231 property?
Yes.
It is. If I have a building that has a lot that's next to it, or a building with ground on it, is the ground 1231 that's underneath it? It is.
Yes.
Is the building also 1231? But aren't those two things on separate sides of that equation?
Correct.
Correct. So the land is always going to be 1231. So what does that mean? It's always going to be 1231 because I just said we got to categorize what we're dealing with. Did I not? And 1231 is a category. Well, it's something more than a category. So we're going to move on to the something more than a category because this helps you diagnose whether you have to run it through the 1231 rules. Okay? 1231 really, not really, in addition to being a category, it says, wait a minute, 1231 is a gateway. And you have 1245 and 1250. And under 1250, you have recaptured and unrecaptured. So if we use that over here, PP&E is 1245. Building is 1250 recaptured and unrecaptured. So why am I drawing this distinction? Okay? And we're going to get to this. This is going to be better. This is just the beginning of how we're going to analyze this. 1245 is going to be an ordinary income item. And we're going to tell you how we quantify 1245. 1250 could either be recaptured ordinary income item, unrecaptured. What did we say about unrecaptured 1250 earlier? What tax rate is inflicted on it, and what's the character?
25%.
25%
Capital gain.
in capital. Okay? So knowing the rules and how this gets bifurcated and segregated into the proper pieces is the trick. So the definition, Matt, who do you want to call in?
Let's go Carter.
Who?
Carter.
Carter? Carter, what if I say, can you tell me what a 1231 asset is by definition? What is it?
Property used in the trade or business of a character which is subject to the allowance for depreciation provided in section 167, held for more than 1 year, and real property used in trade or business, held for more than 1 year.
Okay? So, I mean, and the way I say it is depreciable property or real property used in a trade or business for greater than 1 year. Right? You heard me rattle that off pretty quickly earlier. And mine captures all of it, but it gets you there. Okay, so once we know that we're dealing with tangible personal property or real property used in a trade or business, let's see. Oh, you know what? Do you know how many years ago I actually put this together? Some of you may not have been born. Okay? So this is going to demonstrate, and for this section, this is, for everything we're talking about in this section, we're going to be talking about 1245. Okay? So 1245 is tangible personal property based on this, is it not? Okay, so this is tangible personal property used in the trade or business. So Carter, what are my fact pattern? What's my fact pattern up here?
He's selling widgets. He purchased a piece of machinery for $100,000. After the second year, he decided to sell the machine, and then he's taken 2 years of depreciation on it for $38,000, and then the remaining net book value is $61,000 on the asset.
That feels just about right. Okay. So in order to demonstrate, one of the things I said earlier is the gain can show up in multiple places in the return. So this is intended to say, what's the procedure to understand what the gain is, and what is the thought process or procedure to understand where it gets reported in the return. So we have scenario 1, 2, 3, 4, and 5. Okay? And you'll notice my net book value, 61,220, 61,220, 61,220 is my 100,000 less the 38, correct? Okay. My proceeds line, scenario 1, 2, 3, and 4, 5, says 75, 220, 50, 220, 110, $1, and 0. Okay. So, did I actually write the procedure on this page? I think I did. Allie, what's step 1?
Step 1, calculate the gain.
Okay. What's the definition of proceeds, Allie?
Cash, property, and then debt relief.
Cash, property, and debt relief. So and now we just break down step one into smaller steps. And actually, one of the things that might make me better in my job than some others is I'm able to look at that and go, well, there's in that one step, there's also sub-steps. I can break things down a little bit better into its individual piece and then put it back together. And let me say that differently. I have to break it down. It's not like I can't avoid it. It's not, because the smaller I get it, the less likely I am to miss something. So embedded in calculate the gain, we already said that we don't want a shortcut. Proceeds is its own thing, which was what, Allie?
So cash, property, debt relief.
Okay, and you always want to think in those terms. Even though this page is not doing that, you always want to think in those terms. So once you have the proceeds put together, what do you compare those proceeds to get to your gain loss?
Net book value.
Net book value, which is how much? Well, let's stick with it. Don't worry about that. Net book value, and then that gives you the gain, correct? So in step one, we are calculating the global gain. And when I say global, you'll see these various lines down here that we have to account for. You have a global gain that then we're going to have to break out into its own specific individual piece. And when we break it out into that own specific individual piece, it's going to shoot out into different places into the return. So what's step two, Allie?
Quantify the amount of prior depreciation taken.
Okay. How much was that?
It was 38,000.
38,720, correct? Or 780? Okay. Step three.
Characterize the gain as recapture or to the extent of prior depreciation.
Okay. And step four.
Quantify the excess gain over prior depreciation taken as 1230 gain, most likely capital gain.
Okay. And why is it most likely? Undercaptured what?
Personal funds.
Undercaptured 1231. Going back to that $500 loss at the beginning, if it gets to net capital gain, net 1231, you always have to stop and ask the question, do I have any prior 1231 losses that are going to affect the character of that gain? I'm telling you, somebody in the firm, they had a call, said, hey, what's the tax on this $2 million? Well, it's $400,000. Well, they weren't smart enough to look back at the prior undercaptured 1231, which was $1 million, and that was not a good conversation to have. The tax was what it was, but it still was a surprise to the client that the number we gave them wasn't the number they paid. And they wouldn't plan anything differently, but it's still not a very happy moment. Okay? So we're going to do this quickly, and then we're going to do it slowly. All right? So scenario one, Allie, how much do we sell for?
Sold it for 75,220.
What's our net book value?
61,220.
Okay? And our gain is?
14,000.
Okay, so step one, we quantified the gain, did we not? How much was the gain? 14,000. What's step two?
Step 2 is quantify the amount of prior depreciation taken.
How much was our prior amount taken?
It was 38,780.
Okay? What's step three?
Characterize the gain as recaptured to the extent of prior depreciation.
Okay? So that is our gain bigger or smaller than our prior depreciation? Smaller. So that means that number fully is going to be recaptured as 1245 income. And going back to that 1231 netting, you have to get to 1231 before you even get to the netting part. We didn't even get to 1231 because 1245 is a gateway to get to 1231. To the extent of prior depreciation, you're never going to get to 1231. So the prior depreciation is 38,780. We're not going to sniff at, get to 1231 until 100% of that depreciation has been recaptured. Okay? So then we sell it in scenario two. CV, what's scenario 2?
Scenario 2 had proceeds of 50,220, net book value of 61,220 for a gain of, or for a loss of 11,000.
Okay? And if that's the only activity that we have in this year, is that capital or ordinary?
Capital.
Capital. How do you feel about that, Matt?
I would disagree. I think it's an ordinary loss.
Why do you think it's ordinary?
Actually, trying to remember the rule on that.
Ask Chris.
Chris? It's ordinary.
But why? What rule did you read?
So 1231 losses in excess of gains are always treated as ordinary.
Okay? And if this was our only activity in the current year, do we have a 1231 loss in excess of our 1231 gains? So the Chris rule, which says losses in excesses of gain, is ordinary. And I do this to try to you were the guy reading it, now I'm going to pin it on you, and when I say Chris, everybody's like, oh yeah, that's the rule, right? And it's the alley rule where gains in excess of 1231 is capital, except for this netting thing. You got the more complicated side of things, Allie. Okay? So, what was it? I fell asleep, CV. What's the character of this gain?
Ordinary,
Why again?
because it's a loss.
It's a loss, and it's the only activity in the rule that says a loss is ordinary because the 1231 loss exceeds the 1231 gains in this given year. Okay? Who you want to call in?
The other corner.
Oh, there you are. What's 3 say?
They sold for 110,000, net book value 61,000, leaving a gain of 48,000. There's a 1245 gain of 38,780 and 10,000 1231 gain.
Okay, so now here's the interesting thing. Okay? You okay? You're over there, you're ciphering, I can see it.
I'm thinking.
Go, what are you thinking?
I'm just trying to remember what number is capital and what number is ordinary. But one is one, right?
Well, my favorite answer, it depends, but if this is the only activity in the current year, one's ordinary and one's capital. Except if we have any unrecaptured 1250, right, Allie? Okay? So here's the interesting thing. I said earlier the only way you're going to get to 1231 gain to do the netting that Allie has to determine whether we have any unrecaptured 1231 losses from the previous year is we got to have the full depreciation recapture. So the depreciation was 38,780, was it not?
Mhm.
So our gain, because we know we have to calculate a gain in step 1, just get a global gain. To the extent we have prior depreciation, we have to recharacterize that as ordinary for 1245. You have to recharacterize that as recaptured, and then any excess or the remainder of the gain is going to be 1231 gain. Well, let's take a look. How much did we buy this machine for? 100. How much did we sell it for?
110.
110. So the rule is the only time you're ever going to have a 1231 gain is when there's actual appreciation in the asset. That is the only time you're ever going to have 1231 gain. Connor, how often do you think a tangible piece of personal property is going to have 1231 gain associated with it?
Very rarely.
Very rarely. I mean, I don't know that I've ever seen it. But now, 1250, on the 1250 side, oh yeah, we'll have appreciation. You have a building that appreciates, it's a meaningful asset. A widget machine, not so much. Okay? Who you want to call in, Connor?
Do Mr. Gilbert.
What's 4?
Scenario 4, so you're selling your, let's see, you have the net book value, and then you only get $1 in proceeds. So then that all goes into a net loss for 1231.
I'm assuming that this is the only activity. What is the character of that loss?
That's going to be an ordinary loss.
And why is it ordinary?
Since it's the only, there's no gains or it exceeds any gains, which there are none.
Okay, so therefore it's ordinary. And you remember why we said it was ordinary? What was the magic words?
When when losses exceed gains, or wait,
When losses exceed gains, you actually highlighted it.
Mhm.
What were the magic words?
such gains and losses shall not be treated as gains and losses from. Oh, oops. Yeah, the section 1231 gains for any taxable year do not exceed the section 1231 losses for such taxable year, and such gains and losses shall not be treated as gains and losses from sales or exchange of capital assets.
Sale or exchange. Okay, so what's that dollar doing up there? Did somebody give me something?
Yes.
They did. And did I give up the widget machine for $1? Is that a sale or exchange?
Yes.
It is. Well, let's do the next one. How much? Oh, well, first of all, how much is your ordinary loss in scenario 4?
That would be the total 61.
61 what exactly?
61,219.
61,219. So what's happening in scenario 5?
That's not a sale exchange, so it doesn't go into 1231.
But what's the character of that?
That's also an ordinary loss.
It's also an ordinary loss. Okay? So the reason I'm bringing this up is we fuck this up all the time. And we do we not?
We do.
We do. And I try to beat people into submission. Do I have depreciation software on my machine?
You personally?
Yes.
Probably not.
Probably not. I don't. Okay? But people put things into the software and take things out of the software. And if we're not paying attention, okay, even though there's no proceeds in the system, it spits out as a 1231 loss. Why is that a problem?
Because you got that carry forward for 5 years.
Because you got that carry forward. We're doing a client a massive disservice by not paying attention and making sure that that's treated as ordinary in the system. Now, the sheer purpose of these two is to demonstrate the difference between sale or exchange of the dollar and the abandonment of 0, because my abandonment loss is 61,220. How much, Luke, was your sale or exchange?
That would be $1 less. So
Be $1 less. Boy, that feels just about the same, doesn't it? All right, so now that was the quick piece. Yeah.
Just on your point, I think the Access calculates like ordinary losses correctly when you put in no proceeds. But to get it to work in fixed assets, you have to go into the sale, and then you have to hit, I think it's forced to part 2 of Form 4797, and then it'll put it in the right spot.
And I'm talking about the depreciation of software.
Yep.
Because that's what is going to kick it out, and then that's going to be the thing that is informative potentially to the person putting in the access,
Right.
I think.
Yes.
So that's a great point, because I'm talking about the depreciation software. That's where the error starts, is in the depreciation software.
Is there not an abandonment button when you're trying to put in the sale or abandonment?
I don't know if. Well, I think that you hit either sold or scrap. I think that sold and scrapped is on the same tab, but then you have to hit forced part 2 of Form 4797.
And what does that part 2 add? Just curious.
That's where you want it on the return so that it shows up ordinary instead of on the 1231 section.
And we're going to show that.
Sweet.
Okay, so that was, believe it or not, that was the fast way, because we're just talking about this conceptually. Okay, so if we're going to do these scenario by scenario. And just out of curiosity, we talked about separately stated items, didn't we? So stupid question. Ordinary income items on page 1, everybody treats the same. Other items on Schedule K, they don't treat them the same because they have there's an opportunity to treat them differently at the 1040 level. Okay, so keep that in mind as we're going through here. That's why this is popping out in multiple places in return. Okay, so let's go over the fact pattern just for a second. Okay, this is Doobie Manufacturing, whatever. We got a number there. Who cares for now? But we're going to look at the balance sheet for a second. Here's the balance sheet of the entity. And we have the $100,000 acquisition cost. We have the $38,000 accumulated depreciation. We have the $61,220 of net book value. We have $10,000 of common stock, $90,000 of APIC, and we have $38,780 of negative retained earnings. Everybody got that? Okay. Then, how do I get rid of this? Anybody know? Because that's going to annoy me. So there's the 75,000, and actually, you probably want to keep your, back to the example page. Keep that just so we know which one we're on. I mean, did we have 75,220 of proceeds in scenario 1?
Yes.
We did. How much cash do I have on this balance sheet? 75,220. I no longer have the machine, correct? And I have 24,780 of net income, which when I come down to my AAA section, I got negative 38. There's my 14. There's my 24. It all kind of ties out, correct? So 4797. Part 1 is sale or exchange property used in a trade or business, and involuntary conversion, and other than casualty, most property held more than 1 year. Why does it say most property? What the flip does that mean?
No idea.
Huh. Whatever. Okay, and then this is the part 2 that Trent was talking about for the abandonment. We'll get there. But then you have this page 2, which this is going to be for the sale of your depreciable property. So this is your building, this is your PP&E, this is everything. So line 1 of this is what's your proceeds? So this goes back to, Allie, what was step 1 on our procedure? It was calculate the gain, right? Okay, so this top part is just calculating the gain. What is my proceeds? 75,220. My original acquisition cost was 100. My depreciation was 38,780. My adjusted basis 61,220, which results in a $14,000 gain. Then line 25. This is now making you say, step 2, what line 25A says, what amount of depreciation did you take in the past? It's the 38,000. Is that what step 2 is, Allie?
Yeah.
Okay. What depreciation did I take in the past? 38,780. Then enter the smaller of 24, 14, or 25A, 38,780, which is 14. Okay, so this form does step 1, calculate the gain. Step 2 tells you how much is recaptured and how much is going to be 1231. And then it comes down here to the bottom of the page that says total gains allowed, and then you have to total up the amounts in 25B, G, C, whatever, whatever, and whatever. Okay? So 24 is right here, right? That's my total gain. So they're expecting you to take total gain down to 30, because you could have multiple assets that are being sold, correct? And you're going to have variations on recapture associated with those multiple assets. So it says quantify the total gain that's occurring up there. Then it says, all right, tell us what is recapture. And this allows you to compare and contrast what is 1231 versus not. Well, all this is being recaptured, which tells us that it comes over here. What's that say? Gain in infinity from line what? 31. What number is this over here? 31. Okay, so now that populates this form. This summary then captures that number, because it could, if it was bifurcated, just like what we said before, we have 500 of ordinary and 500 of whatever. No, that's bad. Forget that. That's not right. Just discard the whole comment. 14 goes here, then 1231 or 1245 recapture has nowhere else to go other than page 1, because ordinary recapture, 1245 recapture, nobody has the opportunity to treat it differently. Then it comes down here and then populates page 1 over on Schedule K. Okay, so that number, one gain loss, has popped up in the return, and we haven't even gotten complicated yet. 6 times in 6 different places. So then we go to 2. Here's the same balance sheet, right? We have 50,000 of proceeds the same way we had it before. There's nothing over here, because this is gains from, not gains and losses. So it's an asset that we used in the trader business for 1 year, more than a year, and we have $11,000 loss. Based on everything that we've said today, where do you suppose this $11,000 go? It's ordinary in treatment. We all agree on that, I think. 1231 losses is ordinary, is it not? Are you sure? Chris, is this, do we know this is ordinary?
1231 losses?
Yeah?
Yep, ordinary.
Jackson? Is this ordinary?
Yes.
Matt?
Depends
On?
if they have 1231 gains.
Who's they?
The individualist gets distributed to.
Does anybody know this at all?
No, that's why it's in a different spot.
So you, since it's potentially treated by differently, where do you suppose that you're going to see this?
Schedule K.
Schedule K. Okay, so the first one with $14,000 income, nobody has the opportunity to treat that differently. The loss, the 1231 loss, has the opportunity to be treated differently because of what kind of netting, Allie?
What?
What kind of netting?
Oh, the 1231.
1231 netting. And that 1231 netting is not occurring at the entity level. It's occurring at the individual level. So the 11,000 goes to Schedule K, 1231 gain or loss. Okay? Three. Okay, so how do you suppose this is going to go? Okay, step 1 is we calculate our gain, correct? 110 versus net book value of 61,220, but we have original acquisition cost of 100,000, depreciation of 38,780. We have an overall gain in step 1 of 48,780. Right, CV? Okay, so now we've accomplished step 1. Step 2 is now we have to to discern how much of that is 1231 versus 1245. So then we have to go down to line 25 to say, hey, what depreciation was allowed or allowable? And remember how we talked about allowed and allowable the other day? If we were allowed to take bonus depreciation and didn't, they're still going to ding you for it from a basis perspective. We took 38,780. It says enter the smaller of line 24, which is 48,780, or 25A, which is 38,780. Jackson, which is smaller?
The depreciation.
The depreciation. So now we enter there 38,780, and then down below it says, hey, you have to sum up all this line, and you have to sum up all these lines that they told you. So the sum of all these lines is 48,780, is it not?
Yes.
The sum of all these lines happens to be 38,780, and then we have to populate the amounts below. Okay, so there's the 48,780, there's the 38,780, and then there's the 10. So before line 31 went to that part 2 on page 1, where do you suppose line 32 is going to go? Part 1. Okay? So the 38,780, my eyes are so damn bad I don't know what to do with myself. The 38,780, where does that go? Yeah,
Page 1.
page 1.
Yep.
The 10,000,
That's going to go to Schedule K.
that's going to go to Schedule K. Okay, so now we have a gain that's reported on page 2 of the 4797. Page 2 sends it to 2 spots on page 1 of 4797, and then those numbers go to page 1 of the return and Schedule K. That comes from page 1, and there's the 10,000. Okay? Then we have the 61, which goes, since it's lost, it goes to this page. The 61,000. Jackson goes where?
Sorry, I lost you. Schedule K, though, I believe.
It does. Max, how you feel about that?
I feel good about that.
CV? You feel good about that? Sam, how you feel about it?
I think good.
Allie?
Good.
Good. Carter? I think generally people get paranoid at this point. It clearly goes to Schedule K. Okay? So then we have the abandonment. Ah, damn it. It goes on part two, ordinary gains or losses. And where do you suppose that goes?
Page 1.
Page 1. Because nobody would have the opportunity to treat that differently. Now, Trent, how often do you think they're going to be referring back to this book?
Quite often.
People use this all the time. I mean, because it is hard to remember where all these things go under, and I think I've captured pretty much every scenario under 1245 that might happen to you. And when you put something in the system and something spitting out, this is a roadmap or guidepost to say this is how the system should be spitting out the information. And it gives you an opportunity to self-review and know it. And this is one of those things when I say that we're trying to inflict maximum amount of discomfort to minimize discomfort during busy season. This is one of those items for sure. How often do we buy and sell equipment on a return?
Quite often.
Quite often. This is not a one-off thing. This is something you're going to see and confront all the time. Anybody got any questions about that?
I have a question.
Yeah.
So just to re-clarify, so a 1245 gain is recaptured into income? Is it, or I've forgotten kind of.
Okay, so so let's go back to our
Or
steps.
12,
Okay, the step one was what? Allie? Calculate the gain. Okay, and 1245, in my view. So what's scenario 3? on there?
yeah.
What's scenario 3? Is
That
where-
that has both 1245 and 1231.
Okay, so once we complete step 1, calculate the gain, which that's what's happening on page 2 of the 4797. That's where we know we have a total gain that has to be accounted for. And in the third scenario, the only way you got to 1231 was by genuinely having appreciation, or 110,000 of fair value versus 100 acquisition cost, is 1231. So 1245, the methodology is I got 48,000 whatever of gain.
3878 or
It's 48, right?
48,780 is the total. gain.
First thing you got to do is what's my past depreciation, and all that's going to be ordinary income. That's going to go to page 1 of the return, and then the 10 is 1231, and that's going to go to Schedule K. Now I don't know if I answered your question or not.
No, that did. And
Okay.
so then in that scenario, do you have to like, for tax planning, do you have to make sure with like section 179 and all that, like if you know you're going to sell an asset or you know it's going to be appreciating, like do you want to take less depreciation on that? Or so you don't have like an ordinary income?
Well, if you're going to be selling it next year,
Mhm.
I mean, that might be worthy of discussion. But the only time the most common is, what are tax rates going to do? Because in general, as a good tax professional, you want to defer income and accelerate expense. And when that gets flipped on its head is when tax rates are going up in the next year. In that case, you want to accelerate income and defer expense, because you get a maximum amount of utilization out of your expense if the tax rate's higher in the following year if you defer it. You get the maximum amount of damage to your income if you report it in the year with less tax rates. So, all right, let's see. Any questions? Now this next part's harder. Okay, so let me ask a question. What category of assets did we just talk about?
1245.
1245, and if you were going to say to a non-tax person, if you walked up to a person on the street, we're going to talk about 1245 assets, and they were like, great.
I would say tangible personal property, but that's not a great.
No, that's exactly
Would
right.
you call it that? I mean,
Yes.
I feel like some random Joe Schmo off the street is like, oh, whatever that means.
Well, 100%, but they're going to be closer to the words tangible personal property and potentially knowing what that means versus 1245. Okay, so 1245, that's exactly what I was shooting for, Max. Tangible personal property, 1245 is tangible personal property. So what is the other bucket that we have to contend with?
1250
And what's in 1250?
buildings.
Under buildings, there were two possible treatments or classifications for the depreciation. What was it?
Recapture, unrecaptured.
Recaptured, unrecaptured. So how does one go about quantifying recaptured versus unrecaptured? And what does that even mean? Does anybody know what that means? I didn't know for years, honestly. Okay. I hate this. All right, so let's talk about a definition for a second. not definition. Let's talk about procedure or the way we interact. Let's see. Who gets picked on the least here by vote?
Jackson.
Is it really Jackson? Jackson's got the first vote. Jackson, will you concur with that?
I disagree. I think
Okay.
I talk a decent amount.
Okay, who do you think then?
I don't know. Honestly, Connor maybe.
Yeah.
Uh-oh, Connor, this is trending poorly. Is everybody going to throw Connor under the bus here?
Yep. I'll jump,
Oh.
jump on the pile.
Is that what's happening? CB, do you feel that way? Allie?
I think so. I think so.
Share the same name. Come on.
Wow. Well, this is easy. I think this is easy. Okay, is when you have a residential real estate property or you have an office building, do you know the number of years it gets depreciated over?
Isn't one like 27 and a half? And
Yep,
the other's like 30 or 35?
39.
30.
Okay, close enough. And when you depreciate it, does it go under makers and accelerated, or is there an alternative?
Can it just be straight line?
Straight line. Okay? So in general, a building is going to be depreciated ratably straight line over the life of the building at 27 and a half years or at 39 years. Okay? So, if that's true, the amount that you have to worry about recaptured 1250 is 0. Because recaptured 1250 is the amount of accelerated depreciation taken over straight line. Okay? So if you have a qualified leasehold improvement or something where you've taken bonus depreciation or where you've taken 179, am I missing anything?
Not that I can think of.
Okay. That would be accelerated depreciation associated with that building. So, Max, just to be clear, I kind of fell asleep in the middle of my concept. If it's straight line, do I ever have to worry about recapture 1250? No. Why?
Because there's no accelerated piece.
How you feel about that, Luke?
Yeah, pretty good.
You feel pretty good?
Yeah.
Allie?
Yeah.
You feel good about that? Okay. So, if I have straight line, there is no recaptured 1250. So we're going to compare and contrast for a second because this one blew my mind. So if I have a widget machine and I take bonus depreciation on that widget machine and I sell it 20 years from now, the acquisition cost was $100,000. We took the full $100,000 depreciation from bonus perspective and we sell it for 50. Based on what we just did, how much is my 1245 gain? 50. And what's that taxed as? Ordinary. Okay? Now, what's weird about 1250 is that if I buy a building for $100,000 and I take bonus depreciation on that building for $100,000 and it has a 39-year life, and I get to the end of the 39-year life, and I sell it for $50,000. How much is my my recaptured 1250?
150.
Do what?
Is it 150?
I bought it for 100. Took bonus, net book value year one to 0, which is ridiculous. That wouldn't happen. Get to the 39th year, because it's a 39-year property. I choose that for a specific reason. You get the 39th year, and you sell the building for 50. How much is my recaptured 1250?
Shouldn't have any.
Would it be 0?
How do you draw that conclusion?
Because it should, it should, regardless of if it's accelerated or not, there shouldn't be any depreciation remaining, or there shouldn't be any net book value remaining. Correct.
Well, from what perspective? Okay, so the rule is, and I said this earlier, but I'm really highlighting it right now, it's to the extent accelerated depreciation exceeds straight line. Well, if I'm going to change it to $39,000 building because that's easy math. If I took $39,000 of bonus or depreciation year one, which was all accelerated, and I could have taken $1,000 of depreciation over straight line, how much was in excess of straight line?
38.
38. But we get to year 39, well, now what's the answer?
Oh, this is in year 39. So we still have $1,000 that should have been depreciated out if we were using straight line.
Sure.
So we'd have about $1,000 of recapture.
Sure. He's hitting the nail on the head. So you have this moving target with tangible personal property, or 1245. It's always going to be the depreciation taken. In this case, you have to measure the accelerated depreciation that was taken versus, well, taken, that's probably the best way of saying it, versus where my straight line is at the moment we sell it. So it's a moving target, where 1245 is just a known. So in this case, I'm saying that I have a building with an acquisition cost of $1 million, and I have accumulated depreciation of $8,330, and how I arrived at these numbers, I'll never know. Net book value at $991. Net book value on straight line would have been $995. Excess over straight line is $3,633. I don't know what the hell. We'll come back to whatever this is. It's going to pop out, I'm quite sure. Okay, so if we sell this building in scenario 1 at year 7, we have $1.5 million of proceeds. We have $526 of net book value, correct? Step 1 in the whole process is calculate the gain, correct? So 1.5 less 526, I got a gain of 973. So then you have to say, well, what is the amount in excess of straight line? 68,813. So my recaptured 1250 is 68,000. My recaptured is 404, and my 1231 gain is 500. And 1231 gain is only going to happen when, Chris?
When the asset appreciates.
When the asset appreciates over the original acquisition cost. Okay, we bought it for $1 million, we sold it for $1.5 million. But if you compare and contrast that, you would say, well, in scenario 2, we sold it in the last year, and there's no net book value, there is no excess over depreciation, so you have undercaptured 1250 for the full amount of $1 million, and 1231 of 500. So when we, God willing, come here, this says 973 is the gain, 68,000 I think was the amount that was amount in excess, right? And 904 was the excess over that, which then says 973, 68. There's your 904 and 68, and it should break out, which I don't think it gives you the opportunity to. Now this is the interesting thing, okay? How much on that page was 1250 undercaptured? On the gain loss calc, it was 404, right? So 68 went to page 1 because it's ordinary. Nobody has the opportunity to treat that differently. And what it took some people a little while to figure out is the 904 that came from the 4797, there she is. That's the 904. But the system, based on how you have it input in the system, says embedded in that 904 is $404,667 of recapture. So this 904 has two components embedded in it because it's 1231 gain and that's how it's reported. And maybe it's because both go to Schedule D, maybe, possibly. Embedded in this 904 is 1231 gain of 500, unrecaptured 1250 of 404. Those total up to the 904, and the 404, it gives you the information that you have 25% recapture or unrecaptured 1250.
If there's a situation where you have a carry forward of ordinary losses or like 1231 losses, can it revert that unrecaptured 1250 to ordinary? Got it.
Because it's gonna globally do it first. Okay, and then if we have the sale or exchange, that's not where I want it to go. There's 1.5, there's nothing in excess. 1.5, 1.5, that's going to still populate on the previous page to 1.5, and then it's going to go to Schedule K. 1.5, total 1231 with $1 million being unrecaptured 1250. And if you're doing a gain loss calculation for a client, or they say, hey, we're about ready to sell, and you know that there's embedded in their balance sheet accelerated depreciation associated with their buildings, you have to work through this chart to say, well, wait a minute, you know, this chart doesn't spit out from anywhere, does it, Trent? It doesn't, does it? So you have to say, okay, well, here's this $1 million. Here's my net book value in year 7. And now I have to run out a straight line depreciation schedule and compare what my net book value would be, and then compare those two numbers for that number to spit out. It just doesn't automatically spit out.
So you only see this with stuff like QIP and land improvements. Like obviously buildings are depreciated at 39 or 27 and a half.
Generally, yeah.
Okay.
And I would say for the first 15, 20 years, whatever, of my career, what are you talking about? This just didn't show up.
Right.
But with some of the opportunities for accelerated depreciation that are now provided today, this now shows up. Do you guys have any questions about 1231? No? Not so much? I don't think they like it as much as previous groups.
You'll learn to appreciate it.
You'll learn to appreciate it. Okay.
Nice one.
Do what?
He said annual depreciate.
Who said that?
Sam.
That's funny. All right, let's see. I think that's the only thing in this particular one.